Now your module number 12, and the chapter related to this is chapter 6. So we have accounting for foreign currency transaction. During the first term, we involve accounting for foreign currency translation. First, we have to distinguish between measurement and denomination, or measured and denominated. So we have to understand these two terms in accounting for foreign currency transactions. Assets and liabilities are denominated in one currency if their amount is fixed in terms of that currency. However, they must be measured for financial reporting purposes in another currency. So before we had our accounting for foreign currency translation. When a transaction is to be settled by the receipt or payment of a specific currency, the receivable or payable is said to be denominated in that currency, regardless of the currency in which a transaction is denominated. The party to the transaction measures and records the transaction in the currency. So we have the local currency in which the party is located. For example, a Philippine importer purchases goods on credit from a U.S. exporter who is to be paid in U.S. dollars. The transaction is denominated in US dollars but measured and recorded by the Philippine importer in Philippine pesos. However, the US exporter's transactions is both denominated and measured in US dollars. So in other words, in the Philippines, for the Philippine importer who purchases goods on credit from a U.S. exporter, he will be paying in U.S. dollars. However, the transaction is denominated in U.S. dollars but measured and recorded by the Philippine importer in pesos. However, the U.S. exporter will record both, no? Both denominated and measured in US dollars. So we now go to conversion and translation. It is important to know that the distinction between conversion and translation of foreign currencies, we have to distinguish conversion from translation. In the case of the example above, the Philippine importer converts the Philippine pesos on the date of payment into US dollars at the prevailing exchange rate. On the other hand, the assets, liabilities, and operating items of a foreign branch or subsidiary are translated into Philippine pesos to consolidate them into the financial statements of the Philippine Home Office or parent company. No actual exchange of currencies is involved but only a translation into a single currency. So now we have to consider the current exchange rate. The exchange rate is the rate in which the currencies of two countries are exchanged at a particular time. The buying and selling of foreign currencies as though they were commodities result in variation in the exchange rate between the currencies of two countries. For example, a daily newspaper might quote exchange rates for the US dollars as follows based on the prior day's transactions in the Philippine Stock Exchange. So we have now the accounting for foreign currency transactions. A transaction that requires settlement or payment in a foreign currency is called a foreign currency transaction. A transaction with a foreign company that is to be part or to be paid. A transaction with a foreign company that is to be paid in Philippine peso is not a foreign currency transaction to a Philippine company because the amount of peso to be received or paid to settle the account is fixed and is not affected by subsequent changes in the exchange rate. Thus, a transaction of a Philippine company with a foreign company to be settled in pesos is accounted for in the same manner as if it is a transaction in that had been with a company in the Philippines. Often, however, the transaction described is negotiated and settled in terms of the foreign company's local currency unit. In such cases, the Philippine company must account for the transaction denominated in foreign currency in terms of Philippine pesos. This accounting described as foreign currency transaction is accomplished by applying the appropriate exchange rate between the foreign currency and the Philippine peso. Some of the more common foreign currency transactions are number one, importing and exporting goods on credit with the receivable or payable denominated in foreign currency. Two, borrowing or lending denominated in foreign currency. Three, entering into a forward exchange contract to buy and sell foreign currency. Next is importing and exporting goods. This is the most common form of foreign currency transaction. In each unsettled foreign currency transaction, there are three issues. So we have now the three issues of concern of the accountant. These issues and the appropriate exchange rate to be used in translating accounts denominated in units of foreign currency, except for forward exchange contract, are as follows. Number one, at the date of the transaction. At the date the transaction is first recognized. Each asset, liability, revenue, gain or loss arising from the transaction is measured and recorded in Philippine pesos by multiplying the units of foreign exchange by the closing exchange rate. That is the spot rate in effect on a given date. At each balance sheet date that occurs between the transaction date and the settlement date, recorded balances that are denominated in a foreign currency are adjusted to reflect the closing exchange rate in effect at the date of the statement of financial position. Foreign exchange gain or loss is recognized for the difference in the exchange rate between the transaction date and the balance sheet date. Okay? And the third is at the settlement date. So at the settlement date, in the case of a foreign currency payable, a Philippine company must convert Philippine pesos into foreign currency units to settle the account, while foreign currency units received to settle a foreign currency receivable will be converted into pesos. Although translation is not required, a foreign exchange gain or loss is recognized if the amount of peso paid or received upon conversion does not equal the carrying value of the related payable or receivable. Now we have the marginal deposit on letter of credit. Some banks may require importers to make a marginal deposit upon opening of letters of credit. An example, let us assume that BPI required Manila Corporation to give 25% marginal deposit on the $10,000 letter of credit. The exchange rate given by the bank on November 15 is 50 pesos to 1 US dollar. The entry to record this transaction is to debit on November 15, debit to marginal deposit on letters of credit 125,000, and we are going to credit cash to record marginal cost on letters of credit. So we now have on the date of settlement of the letters of credit, this marginal deposit is applied as payments. Next, we have the two transaction perspective and one transaction perspective. The journal entries reflect the two transaction perspective for recording foreign trade transaction. Under the concept of Manila's transaction with the U.S. supplier, basically were two separate transactions. One was the purchase of the merchandise, and the second was the acquisition of the foreign currency required to pay the letters of credit for the merchandise purchase. Under the one transaction perspective, Manila's total foreign exchange loss of 4,000 on its purchase from the U.S. supplier. We have the amount now should be applied to increase the cost of the merchandise purchase. Under the approach, Manila would not prepare a journal entry as of December 31, 2016, but would prepare the following entry on January 10, 2017. So debit on January 10, acceptances payable for 505,000. We again debit to purchases 4,000 and credit to cash. So to record the payment of the letters of credit of 509,000 and increased purchase for resulting forex loss. In effect, the one transaction perspective considers the original amount recorded for the purchase of foreign merchandise and as an estimate, subject to adjustment when the exact cash outlay required for the purchase is known. And the authors support the two transaction perspective for foreign trade transactions and for loans receivable and payable denominated in foreign currency. And we have here the foreign exchange gain or loss, or the forex. From the foregoing illustrations, it shows that increases in the selling spot rate for a foreign currency required by a Philippine company to settle a liability denominated in that currency generate foreign exchange losses to the company because more Philippine pesos are required to obtain the foreign currency. Conversely, decreases in the selling spot rate of produce foreign exchange gains to the company because fewer Philippine pesos are required to obtain the foreign currency. In contrast, increases in the buying spot rate for a foreign currency to be received by a Philippine company in settlement of receivable denominated in that currency generate foreign exchange gains to the company. Decreases in the buying spot rate produce foreign exchange losses. This, we have the illustrations in the book of Dayag that will further explain these transactions in relation to foreign exchange transactions. Now, will you refer first to the theory in chapter 6? So we will be able to understand some of this. You refer to page 590. Page 590. Okay. Now, on page 590, we have the fill in the blanks. We also have true or false and the multiple choice questions to follow up to number 100. Now, I'm going to begin with the theory part for the fill in the blanks and true or false and the multiple choice questions. And then after that, I'll move on to the multiple choice problems. Now your assignments remain steady for you to answer X problem, straight problem 1 and 2. Okay, we now go to the theory for the completion statements. For the completion statements. Okay, let's read through. The organization that establishes international accounting standards is the International Accounting Standards Board or the IASB, International Accounting Standards Board. The pronouncements of the International Accounting Standards Board are called International Accounting Standards or the IAS. Next, number 3, currencies are commodities. Currencies are commodities. Number 4, the actual changing of one currency into another currency is called conversion. The actual changing of one currency into another currency is called conversion. Number 5, the process of expressing amounts stated in one currency in terms of another currency through the use of an appropriate currency exchange rate between the two currencies is called translation. So number 5 is translation. Okay, number 6, the number of units of a foreign currency needed to acquire 1 unit of the domestic currency is referred to as. So number 6 is referred to as